Hello, I'm Stewart Heath, CEO of Harvard Grace Corporation, where we provide finance and operations executive leadership tailored to your organization. In this week's tax topic, I wanted to touch on something that we've been working with on clients a lot lately. Uh, you know, 2020 gave us the year of basically two economies, those that have been impacted by COVID and frankly, those that have been accelerated by COVID. There's not much middle ground from where I sit. Um, anyway, so what the ones that have been accelerated by COVID, they've been on an acquisition trail, finding other businesses that they want to purchase or otherwise acquire. And that always brings up a tax topic. What happens to the tax attributes of the target corporation, such as NOLs or basis or other type carryover type things? What happens to that in the newly acquired organization? Well, those rules are varied on every point, but there's this little problem in the IRS Section 269 where it talks about if your primary motivation is for tax avoidance, then you don't get the tax attributes of the acquired. Yeah, I know very few businesses that would do a transaction solely for tax. Sometimes that it's an added bonus, such if a target company has a large net operating loss carry forward, then you buy it and you use it. Of course, there's been limits on how to do that for years. But here's a few key points to think about if you're looking at another corporation or another business to acquire. Both businesses need to have written documentation, preferably at their board level, or in other words, and otherwise emails to their counsel and stuff like that, discussing the business purposes for this transaction. Perhaps on the target side, it's retirement. That's a fairly easy business purpose. And for the acquirer, the business purpose is expansion of business, or you're getting into a new line of business, or you're buying a vendor, so you're getting better pricing. You need to also talk about the future expectations of profits. This is particularly challenging when you've got a profitable company acquiring one that has historic operating losses. And be mindful if the acquiring company is getting into a new line of business and the target has attractive tax attributes, be very specific about why you're getting into that. So documentation is the key. And all of this stuff has general rules, but you don't want the IRS coming in later and say, well, you just did that to save on taxes, which is very rarely the case, but that doesn't stop them from saying that. So documentation on what your plan is that's contemporary at the time of the deal. It's not documentation you can do 2 years later when you have an IRS audit. Contemporary documentation, notes, board level minutes, and things of that nature. Anyway, thanks for watching. If we can help you in any way, please let us know. We work on these type transactions all the time. Thanks.